Everyone, in today's session, we'll have a look at 5 steps to power charge your wealth planning. Okay. A quick declaration. The information provided here is for general guidance only and should not be considered as personalized tax advice. We recommend consulting a qualified tax advisor or planner before implementing any tax planning strategies. Please note that we're not licensed financial planners and do not provide financial product advice. For tailored investment guidance, consult a licensed financial planner. All right, let's have a look at the steps. Step number 1, prepare a household budget. So prepare a household budget to help you to determine how much income remains after covering your basic living expenses. So this is how a budget look like. Okay, so you actually add in your income and then add all the household expenses. So basically, after you do this, you'll have when you go to the bottom line, you know how much you have left over to cover future investments. Okay, so this is the key. Is equivalent to a profit loss report of a business. Okay, so that's the first step. Okay, the second step is list your assets and liabilities. Okay, so list all your asset and liabilities to identify potential opportunities for loan restructuring, ownership restructuring, and tax savings. So we also have a template for that. Okay, so basically we have different family members listing all their asset and liabilities here. The purpose of that is so that we can see whether there are opportunities to shift investment around between family members. Say, for an example, if a property is giving you a tax loss, you probably want to allocate more ownership to a high income earner in the family group for income tax purposes, because that family member will be able to claim a bigger tax refund on the tax loss. Okay, that's just a small example. Sometimes you can potentially shift ownership structure to a company or family trust as well, depend on what's the underlying investment and whether you're generating a tax profit or loss. Okay, that's the second step. Okay, third step is you need to set some emergency fund or short-term cash flow. So set aside sufficient cash reserves to cover short-term emergencies or cash flow needs. So this is also important. You might want to be a little bit more conservative as well. Say for an example for ourselves, we have 100K left in the bank to cover emergencies. Okay, you might want to have a bit more if you have a family, have children as well. Okay, just so that when emergency happens in life, you have enough cash to cover it, and also it will provide enough income. Okay, for let's say if something happens to you, you lose your income, you have enough cash left in the bank to cover a period of time before you have an opportunity or have time to convert other type of assets to cash. Okay, so this is number 3. So of course, number 4, once you have all the emergency fund set aside, then you'll know, okay, how much you can invest. Okay, so step number 4, invest surplus cash effectively within the most tax efficient structure. Okay, choose the lowest tax income entity for investments that offer the best potential returns. So one example, when you have assets or have investment returns attached to a personal individual taxpayer, you might need to pay up to 47%, okay, depending on your income. And then, but versus in a trust, you could potentially even reduce the income tax to 0. Okay, if you have enough family members to come in to help you to share the load. Okay, in self-managed super fund, the income tax rate is 15%. Future capital gains tax rate is 10%. So compared to 47%, that's much better. Okay, but you need to know or understand how and what will be the tax impact and how to be in compliance with tax law requirements. Okay, when you are shifting asset to different structures. Okay, or how to choose the best structure for yourself. Okay, that's number 4. Number 5, you want to develop a strategic plan in advance of purchasing or selling investments. Okay, planning is essential before purchasing or selling investment assets, as timing can be critical. Okay, before you purchase anything, before you sell anything, it's highly recommended that you talk to us first. Okay, before purchasing, you want to understand what type of asset you want to buy and what are the tax impact. Okay, say for example, using rental properties as an example, apartment that's close to new, the tax impact is very different from a very old house on a big piece of land. Okay, because of depreciation, of course. So that's a typical example. So you got to talk to a tax planner like us, okay, to understand what strategies you need to utilize before you purchase. Of course, selling is equally important, okay, on capital gains tax. You have to talk to an experienced tax planner to understand your capital gains tax liability and whether there's any way for you to help you to reduce it. Okay, and timing is critical as well. Traditionally, most people will postpone selling big assets like investment property after they retire, because then they don't have other income, then they can minimize capital gains tax. All right, that's all the 5 steps. Here is a brief introduction about myself. If you have any questions or need any consultation with us, please let us know. Thank you. We'll talk to you next time.